You bought the breakout. Price pushed to new highs, volume surged, news was bullish, everything screamed continuation. Then the market reversed and never looked back. What if that rally wasn't strength, it was a trap? Smart money doesn't sell into weakness. They manufacture euphoria, absorb your buy orders through an upthrust after distribution, quietly unload inventory at the highest possible average price, then release the ice. You weren't wrong about the move. You were just standing on the wrong side of it. You have watched this market climb for weeks. Every financial headline confirms what your screen is already telling you. Prices are rising, sentiment is bullish, and the crowd is rushing in with open wallets. Your instinct says buy. Every indicator you trust is pointing upward. The news is favorable. The momentum feels unstoppable. And yet something is wrong. Step back from your screen. Step back from the headlines. Step back from the crowd entirely. The trader who acts on what appears to be happening will always be separated from his capital by those who engineer exactly that appearance. Before you place a single order, ask yourself the question I have asked throughout 40 years on Wall Street. Who is on the other side of this trade, and why are they willing to sell to you right now? Understand this fundamental truth about how markets actually operate. Large professional traders, those with the capacity to genuinely move prices, cannot liquidate enormous inventory positions quietly. They require massive buying volume to absorb their sell orders. Without a willing crowd of buyers, they cannot exit. Without liquidity, they are trapped inside their own positions. This is precisely why they manufacture strength. During the distribution process, these well-informed operators work in deliberate coordination with favorable news cycles, analyst upgrades, and bullish narrative to create an environment of irresistible optimism. In today's markets, this machinery operates faster and more efficiently than ever. Social media amplifies sentiment within minutes, algorithmic momentum strategies pile in automatically, and retail participation surges through commission-free platforms making entry frictionless for the uninformed. Every buying climax you observe in modern markets, whether in equities, cryptocurrency, or foreign exchange, represents this same transfer. The wide-range bullish candle with surging volume at market highs is not institutional accumulation. It is institutional distribution. Professionals are not buying that breakout. They are selling directly into your enthusiasm. Your buy order is their exit. Watch the character of price during these elevated ranges. Volume remains persistently high throughout. Downward movements develop wider ranges than upward movements. Rallies become progressively weaker, shallower, requiring greater effort to produce smaller results. These are the fingerprints of supply overwhelming demand, visible to any trader willing to read price and volume honestly rather than emotionally. Here is what this understanding gives you: an extraordinary advantage over the majority of market participants. When you recognize that a seemingly powerful rally is constructed deliberately to facilitate distribution, you stop becoming the counterparty professionals depend upon. You begin reading preliminary supply, buying climax, and automatic reaction not as random price behavior, but as a sequential campaign with identifiable purpose. Modern markets have changed in speed and technology. Human nature has not. Greed still blinds, euphoria still traps. Smart money still needs your buy order to complete their exit. Now you know what to look for before they get it. Price has just broken to new highs. Your breakout alert triggered. Volume is surging exactly as every trading textbook says it should. The resistance level that held price back for weeks has been convincingly shattered. Every breakout strategy you have ever studied is screaming the same message simultaneously. This is the move. Enter now before you miss it entirely. You buy. Thousands of others buy alongside you, then price reverses sharply, decisively, and without apology. Do not act on the first impulse this market presents you. The most dangerous moment in any distribution structure is not the eventual collapse. It is this precise instant of apparent breakout strength. This is the moment engineered with the greatest sophistication, designed to extract maximum liquidity from maximum participants simultaneously. The trader who has not studied this behavior will always react. The trader who understands it will always pause and observe what follows. What you have witnessed is the upthrust after distribution, phase C's defining deception within the distribution campaign. By this stage, large professional operators have already spent considerable time inside the range building their selling positions during phase B. They have distributed significant inventory during every minor rally. But they require one final, decisive surge of buying activity to absorb their remaining sell orders at the absolute highest possible prices, so they manufacture it deliberately. Price is pushed aggressively through established resistance, the highs created by the buying climax. This violent penetration simultaneously triggers three separate groups of participants. Breakout traders enter long, chasing momentum. Short sellers who correctly anticipated distribution have their protective stop losses executed, converting their shorts into forced buy orders. Algorithmic momentum strategies activate automatically, adding further upward pressure within milliseconds. In today's electronic markets, this mechanism operates with remarkable precision. High-frequency algorithms, options market makers adjusting delta hedges, and momentum following quantitative strategies all amplify the upthrust's initial thrust beyond anything Wyckoff witnessed in his own era. The trap is larger, faster, and more convincing than ever before. Yet the underlying truth remains identical. Every single buy order generated by this euphoric surge is being absorbed by professional sell orders. The volume you observe is not bullish confirmation. It is the sound of distribution completing itself. Price cannot sustain above resistance because someone with enormous capacity is selling directly into every buyer who arrives. The upthrust holds above resistance briefly, then collapses back into the range with equal aggression. That swift, decisive re-entry is your signal. Once you genuinely internalize the mechanics behind the upthrust after distribution, this once terrifying price behavior transforms into one of the most reliable signals available to the modern trader. You stop chasing the breakout. You start observing the reaction after the breakout, watching volume diminish, ranges narrow, and momentum fade on the subsequent test. The trap remains identical across every market and every time frame. You are simply no longer standing inside it. Price has been deteriorating for days. The structure that once held firm is visibly cracking beneath the surface. You watched the upthrust fail. You observe the rallies becoming progressively weaker, shallower, more labored with every attempt. Now price is pressing directly against the lowest boundary of the entire range. That critical support level the market has respected repeatedly throughout the distribution campaign, and it breaks, completely, decisively, with authority. Your long position is bleeding. Every instinct developed through months of trading is telling you this breakdown must be a trap. That support this significant cannot simply disappear. Surely buyers will appear here. Surely this level holds one final time. Remove that thought entirely from your mind. Before you add to a losing long position, before you convince yourself that this breakdown is merely another shakeout similar to those you have witnessed in accumulation structures, discipline yourself to read what price and volume are genuinely communicating at this precise moment. The market is not asking for your opinion about whether this level should hold. It is telling you, through every candle and every volume bar, exactly who now controls the situation completely. The level you are watching break is what the Wyckoff methodology identifies as the ICE, the support boundary established by the automatic reaction in Phase A and reinforced repeatedly by the lows developed throughout Phase B. This is not merely a technical support line drawn mechanically on a chart. It represents something far more significant in terms of market structure. Throughout the entire distribution campaign, this level functioned as the floor beneath which professional operators would not allow price to fall prematurely, not out of bullish conviction, but because they required that price remain elevated long enough to complete their full distribution of inventory. Every time price approached the ICE during Phase B, buying appeared with sufficient conviction to defend it. That buying was deliberate, controlled, purposeful. Now that defense has been withdrawn entirely. When the major sign of weakness develops, wide-range bearish candles, decisively increasing volume, consecutive closes at session lows, it communicates one undeniable reality. The distribution campaign is complete. Professional operators have fully transferred their inventory to uninformed participants at the highest achievable prices. They are now positioned short and actively accelerating the decline. In modern electronic markets, this breakdown triggers cascading stop losses across retail accounts. Simultaneously, algorithmic selling strategies activate on the structural breach, and margin calls begin forcing additional liquidation, creating a self-reinforcing waterfall of supply with virtually no meaningful demand to absorb it. The ICE breaking is not the beginning of uncertainty. It is the end of it. This understanding reframes the ICE breakdown from something threatening into something genuinely clarifying. When you have correctly identified the preceding distribution structure, the buying climax, the failed upthrust, the deteriorating rallies, the ICE break becomes the market's final confirmation rather than a surprise. Control has transferred completely. Direction is now unambiguous. You are no longer watching the market with confusion. You are reading its most honest statement and positioning yourself accordingly. The volume is enormous. Prices swinging violently in both directions across wide ranges every single session. Your trading platform is alive with activity. Alerts triggering, momentum indicators surging, social media erupting with competing opinions about direction. Every session brings a new dramatic candle that appears to promise resolution but delivers only deeper confusion. You cannot determine who is winning. Buyers appear aggressive one session. Sellers dominate the next. The range holds, but nothing inside it makes any coherent sense. You are watching a battlefield so chaotic that identifying the commanding force seems genuinely impossible. Most traders at this precise juncture do exactly what uncertainty always produces. They either abandon their analysis entirely or they commit to the wrong side through sheer emotional exhaustion. Step away from the noise of individual sessions. The trader who evaluates each candle in isolation will always be overwhelmed by the apparent contradiction distribution ranges deliberately present. What appears confusing at the session level becomes remarkably clear when you elevate your perspective and examine the character of activity rather than the direction of individual price movements. The market is communicating its true condition through every bar. You simply need the correct framework to receive that message accurately. Here is the fundamental distinction that separates distribution ranges from accumulation ranges, and it is observable with absolute clarity once you know precisely what to measure. During genuine accumulation, volume gradually decreases as the range develops. Professionals are patiently absorbing available supply, and as floating stock diminishes, fewer sellers remain willing to participate. The range becomes progressively quieter, narrower, more compressed. This decreasing activity reflects genuine absorption nearing completion. Distribution ranges behave in the complete opposite manner. Volume remains persistently elevated and relatively constant throughout the entire campaign. Wide price fluctuations continue session after session. This sustained volatility is not random market noise. It is the direct consequence of professionals actively selling enormous inventory into every rally that attracts fresh buying interest. Every bullish surge brings new uninformed buyers. Every new uninformed buyer receives a professional sell order as their counterparty. The high volume is the audible friction of this continuous transfer from strong hands to weak hands. Examine the character of individual movements within the range with equal discipline. Downward waves develop wider ranges, greater momentum, and stronger volume than upward waves. Rallies become increasingly labored, narrow ranges, diminishing volume, visible struggle to make upward progress. In today's markets, the Weiss wave indicator makes this divergence extraordinarily visible, showing downward volume waves progressively dominating upward volume waves throughout Phase B development. The selling pressure is building beneath a surface that still appears superficially bullish to the untrained eye. This effort and result divergence is the market's most honest confession. When you genuinely understand how to read volume character rather than price direction alone, distribution ranges transform from sources of confusion into sources of extraordinary clarity. The persistent high volume tells you professionals are actively present and selling. The deteriorating rally momentum tells you demand is quietly collapsing beneath apparent strength. The increasingly dominant downward waves tell you exactly which force is systematically winning the campaign. Every session of apparent chaos was actually a page of a story written in plain language. You now possess the ability to read it completely. The ICE has broken. The major sign of weakness is printed with conviction across wide ranges and surging volume. Everything you studied about distribution structures has materialized exactly as anticipated. The campaign is complete. The bearish trend is beginning. But you hesitated. You watched the breakdown without entering. Perhaps uncertainty paralyzed you at the critical moment. Perhaps the speed of the initial breakdown felt too aggressive to chase. Perhaps you simply could not trust your own analysis sufficiently to commit capital when it mattered most. Now price is rallying back upward toward the broken ICE, and every instinct developed through months of painful losses is screaming the same terrifying message. What if the breakdown was wrong? What if this rally reclaims the structure entirely, and you missed the long side completely? Do not surrender your analysis to that voice. That voice has separated more traders from their capital than any market condition ever could. Before you abandon your distribution reading, before you convince yourself that this upward movement represents genuine bullish recovery, discipline yourself to observe its precise character with the same objectivity you applied to everything that preceded it. The market is not finished communicating. It is preparing to deliver its final and most important confirmation. The trader who understands what follows this rally will recognize it not as a threat to their bearish thesis, but as the most professionally structured entry opportunity the entire distribution campaign has produced. What you are observing is the last point of supply, the LPSY. After the IC breaks decisively with the major sign of weakness, price inevitably develops an upward reversal movement. This is not random. It is not genuine bullish recovery. It is the natural mechanical consequence of short sellers taking partial profits, oversold conditions attracting brief technical buying, and momentum algorithms temporarily reversing on the extreme bearish extension. But examine this rally with absolute precision. The ranges are narrow. Consecutive candles overlap each other with no directional conviction. Volume contracts dramatically compared to the breakdown movement that preceded it. Price struggles visibly to make upward progress despite apparently trying. Every characteristic that defined the powerful downward sign of weakness is now completely absent from this upward movement. This is the market demonstrating something profoundly important. Demand has been exhausted. The uninformed buyers who provided counterparty liquidity throughout the entire distribution campaign above have now been fully committed to losing long positions. There are virtually no remaining buyers with sufficient conviction or capital to drive price meaningfully higher. Meanwhile, Professionals who distributed inventory throughout the range are now positioned short and using this weak rally as a final opportunity to add additional selling positions at the most favorable prices available before the full bearish trend accelerates. In modern electronic markets, the LPSY frequently develops with remarkable precision at technically significant levels. The broken ICE line, the volume point of control of the distribution range, key VWAP levels that algorithms reference automatically. These confluences concentrate professional selling activity at highly identifiable price zones, making the LPSY simultaneously more precise and more tradable than anything Wyckoff himself could observe with the tools available in his era. Richard Wyckoff himself identified this location as his personally preferred entry point, not because it offered the largest potential profit, but because it offered something more valuable than raw distance. It offered certainty. The entire distribution campaign is visible and readable on the left side of the chart. The IC break is confirmed. The rally's weakness is measurable. The stop-loss location above the LPSY and broken ICE is logical, defined and defensible. The risk-reward ratio is structured with professional precision. The LPSY transforms the most psychologically difficult moment in distribution trading, the post-breakdown rally that triggers doubt, into the most structurally sound entry opportunity of the entire campaign. Your stop-loss sits above the weak rally and the broken ICE. Your directional conviction is supported by every phase of distribution you identified from the beginning. Your entry is not based on prediction or hope. It is based on the complete, readable, confirmed evidence of everything that transpired on the left side of your chart. The market has shown you exactly what happened. It has shown you exactly who is in control. Now you simply execute with the clarity that genuine understanding always produces. You have sat across from this market every single session believing that price action was random, that the violent swings, the false breakouts, the inexplicable reversals that emptied your account repeatedly were simply the unpredictable nature of financial markets. That no amount of study or discipline could ever reliably decode what was genuinely happening beneath the surface of those candles and volume bars. That belief has cost you enormously, not because markets are dishonest, but because you were reading the wrong language entirely. You were reading price direction when you should have been reading price intention. You were counting candles when you should have been measuring campaign progress. You were reacting to what the market showed you when you should have been anticipating what the market was preparing to do next. Before you place another order in any market, equity, cryptocurrency, foreign exchange, or futures, pause completely. Carry everything you have absorbed throughout this study back to your chart and ask the singular question that separates professional traders from permanent casualties of the market. Who is engineering this price behavior? Why are they engineering it? And at whose expense is the campaign being conducted? That question, applied with patience and discipline, unlocks everything. What you have studied across these 5 keynotes is not a collection of isolated technical concepts. It is a single, unified, sequential campaign executed with deliberate precision by well-informed professional operators against the collective emotional vulnerability of uninformed market participants. It begins with the illusion of strength, a manufactured environment of bullish optimism designed specifically to attract maximum buying interest at the highest possible prices. Favorable news, surging momentum, and social media euphoria are not coincidental backdrops to distribution. They are essential instruments of the campaign itself. Without your enthusiasm, professionals cannot exit. It advances through the upthrust after distribution, the single most sophisticated deception the financial markets produce. A violent penetration of resistance that simultaneously triggers breakout buyers, executes short sellers' stop losses, and activates algorithmic momentum strategies, all generating the concentrated buying liquidity professionals require to complete their final inventory distribution at the absolute peak. It confirms itself through persistent high volume and deteriorating rally character, the measurable, observable fingerprint of continuous supply overwhelming progressively exhausted demand. While price appears superficially strong to the untrained eye, volume tells an entirely different story. Downward waves grow heavier, upward waves grow weaker. The effort required to produce each successive rally increases, while the result of that effort diminishes. The market is confessing its true condition in plain language through every session. It reaches its point of no return at the breaking of the ICE, that critical support boundary whose defense was never rooted in bullish conviction but in professional necessity. When that defense is deliberately withdrawn, the major sign of weakness prints with authority. The transfer of inventory from strong hands to weak hands is complete. The path of least resistance has been confirmed, cleared, and opened for the full bearish trend to develop without meaningful opposition, and it delivers its final professional opportunity through the last point of supply, the weak, narrow, low-volume rally that follows the ICE break. The moment that triggers doubt in underprepared traders becomes the moment of maximum clarity for those who have read every preceding phase with discipline and objectivity. The entire campaign is readable. The confirmation is complete. The entry is structured. The stop-loss is logical. The conviction is earned through evidence rather than hope. This is the complete anatomy of how smart money distributes inventory before initiating a bearish move. Not randomly, not unpredictably, but sequentially, systematically, and repeatedly across every market, every time frame, and every era of financial history. In 40 years of studying Wall Street's most powerful operators, I observed one truth that never changed regardless of the technology, the instruments, or the participants involved. The market does not move against you randomly. It moves against you systematically, and always along the path of least resistance. Your singular advantage as a modern trader is this: that path is readable. The campaign leaves evidence at every phase. The volume speaks when price deceives. The structure reveals what the headlines deliberately conceal. You are no longer the uninformed participant providing liquidity to those who engineered the illusion. You have learned to read the campaign from the beginning. Now trade accordingly.